Let's continue talking gold and its 11-year bull run. Joining us now from London is head of metals research for Bank of America Merrill Lynch, Michael Widmer. Michael, thanks for joining us here on In the Loop this morning. Gold setting a new record this morning. Do you still stand by your forecast of 2,000 by year end?
Yes, absolutely. And I think the data that has been coming out over the last few days just backs it up. On the one hand, I think you continue to see an upward trend in inflationary pressures in countries like the United States. And on the other hand, a lot of the macro data basically comes out relatively subdued, I would say. You can capture that kind of environment through an index like the misery index, for instance, which is the sum of unemployment rate and inflation rate in the United States. And what you can show is that whenever the misery index moves up, which is pretty much kind of a stagflationary environment, gold prices tend to perform relatively well. And I think this, to me, is one of the main price drivers at the moment. On top, of course, the entire debt issues in the Eurozone, and you're faced with years of relatively weaker growth than in the previous decade. Again, makes less competition from other asset classes relative to gold. And to manage that debt burden, this is really important as well in the current environment. What governments would like to do is they would like to keep real interest rates, particularly in the advanced nations, relatively low. In the United States, it's a prime case for that. Real interest rates remain negative. It's a very positive environment for the gold market.
Michael, I got to jump in here and ask you, though. It seems as if the latest run-up in gold, the last, say, $100, has really been headline-driven and fear-driven. Would you agree with that? Which suggests to me that there's a real risk that we could see a rapid sell-off in gold once some calm enters the market again.
That is a risk. And if you're looking at our $2,000 pounds price target, if you're looking where we are trading at the moment, that is a 12-month target, right? It's not exceptionally high relative to current spot prices. I think the next data point that people probably look at is Jackson Hole, and then depends on how the communication there is from the central bankers. I think there is a little bit of a risk that we could drop off. But the gold market has been driven by fear, and I think there was a lot of speculative lengths moving into the market. And yeah, of course, that sets the market up for a little bit of correction at some stage.
How much of a correction, Michael?
But look, I mean, $2,000 is our target. I do think that if prices come off the $100 that you have mentioned, I think we could easily give back in a correction. A lot of the longs that have come into the market, or some of the longs, could be flushed out and take again prices back to levels where we were before the last rise.
So, Michael, there's clearly risk to the downside there, but your target, $200 roughly above where we're trading. So would you say to clients now that didn't have gold positions that they should create them, or should they add to existing positions they have?
This is always a difficult question after a move that we have just seen. I think I would approach that pretty much on whether you are an investor that can withstand some pain. I honestly believe that there is further upside left for gold prices. If you can sustain some short-term losses, I would advise to get back into the market. If not, I think we may at some stage see a better entry point. But in my view, the trend over the next 12 months is for higher gold prices.
All right. Thanks so much, Michael. We got to leave it there. Appreciate your insight. That was Michael Widmer, head of metals research for Bank of America Merrill Lynch.